In the world of global finance, there is a term that gets thrown around a lot, one that signals both massive opportunity and some really serious risk. That term is emerging markets. And today we're going to dig into what they are, why investors can't get enough of them, and why sometimes it all goes wrong. So let's start with a little quiz. What do you think countries as different as Indonesia, India, Brazil, and Russia all have in common? I mean, on the surface, they seem worlds apart, right? But in the world of global economics, there's one really powerful thread that ties them all together. And there's the answer. They're all classified as emerging markets. It's a label that was actually born back in the 1980s. And now it's absolutely crucial for understanding how the global economy works. And for investors with a real appetite for risk, these places can be absolute gold mines.
But what's really interesting is where this term even came from. See, it wasn't born out of some complex economic theory. It was basically marketing. Back in the 80s, a guy at the World Bank named Antoine van Ochtmal noticed that the label Third World was, kind of scaring investors away. So he came up with emerging markets to make these economies sound way more dynamic and appealing. It was a simple rebrand, and guess what? It totally worked.
Okay, so that naturally leads to the big question, right? What exactly is an emerging market? And as you're about to see, the answer is, well, it's a lot trickier than you might think. And here's the thing. If you're looking for one single definitive list of all the emerging markets, well, good luck, because there isn't one. The classification really truly depends on who you're asking and, frankly, what their agenda is. So if there's no official list, who gets to decide? It really boils down to two major players, and each of them looks at the world through a very, very different lens. All right, on one side, you've got the International Monetary Fund, or the IMF. They take this really broad economic view. They're looking at things like how much citizens earn, how diverse a country's exports are, and how sophisticated its financial system is. And by their count, there are 96 emerging economies. But then on the other side, you have MSCI, a private investment firm. Their list? It's way smaller, just 24 countries. And that's because their criteria is laser-focused on just one question. How easy is it for a foreign investor to put their money into that country's stock market?
So that brings us to this idea of a stock index. And really, the easiest way to think about it is like a curated playlist for the stock market. You've probably heard of the Dow Jones, which tracks big U.S. companies. Well, the MSCI Emerging Markets Index is the absolute powerhouse in this space. It's so influential that getting on that list means the world's biggest investors are suddenly paying attention to you, and it guides where literally billions of dollars flow.
Okay, so let's talk about the promise. This is why investors get so excited about these markets. This is the love part of the whole love-hate relationship. And the attraction? It's simple. The potential for absolutely explosive growth. I mean, just take a look at this. The difference is pretty dramatic. Over the last 20 years, some of these emerging economies have been growing at an average of 5% a year. A developed economy like the United States, just 1.5%. Now, that might not sound like a huge difference day to day, but you compound that over decades, and it creates an absolutely enormous gap in wealth.
And this isn't some brand new thing. There's a long history here of outperformance. One report found that about a quarter of all emerging economies consistently beat their peers. You've got giants like China and South Korea who sustain this incredible growth for half a century. And more recently, you've got countries like India and Cambodia that have been expanding at a blistering pace, really lifting themselves into whole new income brackets.
But you know what they say, with high reward comes high risk. And that brings us to the flip side of the coin, the peril. This is the hate part of the relationship, and it's all about high volatility. Get a load of this number, $63 trillion. By 2017, that was the total amount of debt held by emerging markets. And to give you some perspective on just how fast that grew, just 10 years earlier, in 2007, that number was $21 trillion. So it literally tripled in just a decade. That's insane. So why is all this debt so incredibly dangerous? Well, here's the kicker. A huge chunk of it is held in foreign currencies, especially the US dollar. Just imagine you took out a loan, but the amount you owe could change every single day. That's what happens here. When the US dollar gets stronger, these countries suddenly owe way more in their own local currency. It's like the goalposts keep moving further and further away, making it an incredibly tough uphill battle to pay it all back. And this is how it can all unravel. It can trigger this really frightening, vicious cycle. It starts when the country's currency starts to fall, and fast. That spooks foreign investors who start pulling their money out. That, in turn, makes it even harder for the country to raise the funds it needs. Pretty soon, the value of its assets and the stability of its entire banking system are damaged. And before you know it, the whole economy is suffering. So it's really important to remember that this label, emerging market, it's not some permanent brand. It's really just a snapshot in time. This whole landscape is constantly shifting and changing. Basically, a country can move in one of two directions. They can step up, graduating to become a developed nation, which is exactly what South Korea did, or they can step back and get demoted to a frontier nation, which is a category for even riskier, less developed markets. And that leaves us with the big, lingering question. As these markets keep growing and playing a bigger and bigger role on the world stage, will their incredible promise continue to outweigh their very real peril? The future of global growth might just hang on that answer.